Because many of us travel, we're aware of the perilous state of the airline industry and the many trips into bankruptcy that companies like United and others have taken. Less well known is the impact these financial problems have had on airline employees, particularly on their pensions, which in many cases have been erased to the tune of billions of dollars. Yet the money managers who invested that money on employees' behalf made millions and walked away scot-free. How did this happen? I'm Sarah Bartlett, and we'll tell you about it today on USA Inc. Joining us today is Mary Williams Walsh, a reporter with the New York Times who has written a disturbing series of articles detailing the conflicts of interest that are rampant in the pension fund consulting business. Mary, thanks for being on the show today.
Thank you.
Can you tell us a little bit about the United situation that you discovered and wrote so eloquently about? I think it's an amazing story.
They're going through a very long bankruptcy, and part of their bankruptcy is terminating 4 pension funds that the employees of United have been counting on this money for their retirement, and it's a huge, huge, massive failure. It's worth $10 billion worth of benefits that will be either taken over by the government in some cases, or the employees will just bear the loss themselves.
How is it possible that an employee of a major company like that could be setting money aside for their pension, for their future, and actually lose that money? How does that happen?
It's not supposed to happen. First of all, we have a law in this country that's about 30 years old that says retirements are supposed to be a sure thing. And basically, in the United case, I see a really clear example of the law's failings or the breakdown of that law. That doesn't mean every company is now going to lose its pension funds also, but clearly the law, it's supposed to see to it that companies set aside enough money, and there's an insurance system within the federal government that's supposed to backstop that. And it still can turn out that the money's not there.
Can you tell us how the money got lost in the first place? Why is this pension fund bankrupt to begin with?
The rules are that you have to set aside a certain amount of money over a schedule, and the schedule is actually quite complicated, but United complied with it. The thing that the law doesn't get into at all is what happens to the money once it's in the pension fund. How is it invested? Is it invested in secure assets that are going to produce a cash flow that meets the needs of the retirees, or is it going to be in volatile assets, which is what has turned out? It's actually very commonplace in the industry that they invest in stocks and things that don't necessarily have a schedule that they come due on.
And so what specifically happened in the United's case? What types of investments did they make, and why did they go bad?
It's nothing really crazy sounding, actually. They had a lot of stocks. It was a diversified portfolio, but we had a stock market crash that happened. And if that coincides with a company getting into financial trouble itself, right when the pension fund goes down in value, if the company has money, it can put new money into the pension fund, but United couldn't do that because the airline industry is in trouble too at the same time. And right when those two things are going wrong, also a lot of retirees are getting ready to retire. We have the boomer generation coming up for its retirement now. And so it's sort of 3 things all happening at the same time that just put way too much stress on that pension fund.
Now, you wrote about some of the people that were helping to advise United on how to invest. What happened to them?
It's gotten to be commonplace in this industry that a company doesn't sit there with its own pension fund and manage the money itself. They turn to outside money managers. And to find the outside money managers, they often will employ 1 or more consultants. And what you can't find out usually, the government, even though pension funds are very, very heavily regulated, the regulation doesn't always include gathering information on what relationships may exist between consultants, different types of money managers. And so all of that is happening kind of off stage, where the employees, think, well, everything must be fine, but you don't really know for sure that it's fine. The consultants can sometimes have a conflicted situation where they're steering money into certain types of investments because that's what pays their salaries, basically.
But when the money isn't there that's needed, do they have any liability? Do they have any responsibility? Can anyone reclaim the money that they made from this?
Basically, you don't usually see that happen, which is a pretty amazing thing because the whole thing goes to this government insurer. The government insurer was not set up to take a $10 billion hit like this, though. You get too many of those. Right now they have money. I don't want to make it sound like they've run out of cash, but if you get a lot of those back-to-back, which isn't a totally far-fetched scenario at this point, it will run out of money. And then you'll have something that could look sort of like the bailouts that have happened, for instance, in the S&L industry, where there was a government guarantor there, too, that ran out of money.
How much money did the people who were advising United make?
It's, over time, hundreds of millions of dollars.
So they got hundreds of millions of dollars in fees for the work that they'd performed, and presumably no one is saying they didn't perform the work. But the people whose pensions those were stand to lose money. You said it could be several $billion dollars?
Yeah.
And there's no culpability, no responsibility?
It's a really strange situation. It seems to me there's a whole web of different types of professionals that work for pension funds. And if you try to figure out, okay, who made this happen, you never can find any one person or any one sector. You have, actuaries are doing work for pension funds. There are people in the corporation itself that are doing work. There are money managers. There are consultants. There are custodial banks. And sometimes different government regulators, they will be looking at different parts of the industry. So the SEC recently looked at the consultants and said, there's problems here. Except then the Labor Department is looking somewhere else. It would be the Labor Department that I guess would have to come in and say, okay, what should we do to make sure these consultants are performing properly? They're looking at other things. And so it's sort of, if you try to say to yourself as an employee, okay, who's the villain? Who am I supposed to be really angry at here? Who's culpable? You have a web.
So the regulation, it seems, is very diffused and no single agency is in charge?
That's right. You have the IRS looking at some aspects of it. You have the Labor Department looking at some aspects of it. You have this little guarantor, the PBGC is what it's called, and until the last few years people didn't really pay that much attention to it, but now it really does have a lot of financial pressure. They all look at different aspects of the pension fund, but as a whole, it's hard to find anybody who takes all that into account.
And in terms of what happens to the people who lost their money, do they have any recourse at all? Have you been in touch with any of them?
Yeah, and I've interviewed people who are, it's almost hard to describe how shocked and how angry and how betrayed they feel because, this is their deferred compensation. They worked for years and years and years thinking, being told, you have a pension at the end of this time and here's how much it's going to be worth. And to find out after working all those years that, oops, the money isn't there, you only really get to retire once at the end of a career. You can't go back and say, okay, now I'm going to go earn it over, or I'm going to renegotiate, I'm going to get a better deal. It's over by that time, and there's nothing they can really do about it. And the feelings of betrayal are almost impossible to describe.
The thing that's so shocking about what you're describing to me is I remember the Enron hearings where you had a lot of workers testifying, for example, in Congress about the loss of their retirement funds when Enron went bankrupt because of the corporate management scandal there. And there have been many efforts to recover funds from the banks that made the loans, from the lawyers, from the directors. WorldCom would be another example, where the regulators have come in afterwards and said that we have to try to recover some of this lost money, and yet there just seems to be a void in the case of these United employees and presumably not other companies as well. It just seems such a double standard.
It's a different type of pension. It's a defined benefit pension, which is actually a very good benefit if yours works. And most of them still do work, but and in the Enron case, it was 401k types of retirement plans, and so they're regulated differently. With defined benefit pensions, basically this guarantor agency, the PBGC, becomes the trustee if it fails. And they take it over and they will represent you, the plan participant or the retiree, in bankruptcy court. But you and the PBGC are basically unsecured creditors, and unsecured creditors don't do well in bankruptcy court. That's why, there is a legal framework, it's just that you don't have very good chances once things get to that point.
Now, the ultimate backer of the PBGC, the Pension Benefit Guaranty Corporation, is the taxpayer, correct?
Yeah, and we're not to a bailout yet. The way it's supposed to be self-sustaining, so that all companies that have pension funds are supposed to put in premiums. And then in a normal insurance company, the premium money is invested, and then you can pay claims. The claims are too big right now relative to the premiums, and so there's a lot of talk now, well, should we raise the premiums? Well, then other companies aren't going to want to offer pensions anymore, and we know these are good benefits, and so we don't want to steer them away. We want people to be able to count on getting pensions. It's sort of like a vicious circle situation.
Is there a chance that taxpayers are going to be called to task and we're going to have to chip in more money in order to back up the fund?
I think so. I think so. There's a lot of studies that get done, and you can't figure out in advance when that could happen or how much the bailout would cost, but the studies are very credible.
When you look at money managers who've been working in this world with the pension funds, did you find a lot of evidence of conflicts there? Did you feel that the policies were in place to protect?
A lot of different things go on with pension funds. There are big corporate pension funds, there are small corporate pension funds, there are city pension funds, and those can be big and small too. Basically, the big pension funds, they will have a staff and they will screen things and vet things carefully. With smaller pension funds, they have less resources to put into that kind of thing, and so they tend to rely much more heavily on outside consultants. And that's where the risk of a conflict, I think, is the greatest.
United, of course, was not a small company.
That's right. I looked at their documents carefully. Their consultant didn't appear in their documents, which I thought was strange. And I keep hoping that the government will research, what exactly was the role of that consultant, because I'd like to write about it, but so far I don't know.
We'll be right back.
The Zicklin School of Business at Baruch College of the City University of New York is the largest and most diverse accredited business school in the United States, offering high-quality, full-time and part-time degree programs at the undergraduate, master's, and PhD levels. For information about the Zicklin School of Business, please visit our website, zicklin.baruch.cuny.edu. That's zicklin.baruch.cuny.edu.
Welcome back. I'm speaking with New York Times reporter Mary Williams Walsh. Can you talk a little bit about what's happening in Washington since all of this has come about? I mean, is there any kind of effort to bring this under control?
There is. Even before the United pension failure, there was some talk about tightening up the pension rules that companies have to follow. After the United failure, there were a lot of hearings, and the Senate and members of the House wanted to understand, okay, exactly why did that happen? And it came out that you really can, as a company, follow the rules very precisely and still end up wiped out with a pension fund that can collapse like that. United put in the money according to the schedule, but the rules are so full of flaws that that kind of thing can happen. What they're trying to do now basically is find out how to close loopholes, tighten up the rules, make sure companies do put the money into the plans, not just that will follow the rules, but that will keep the plan viable. They're actually having a very hard time doing it too. There are a lot of different interests at stake here, and for some companies, correcting the situation could be very costly.
So what happens now? I mean, where does the political process stand?
There's a bill in the House that has been passed by one committee. The Senate is going through this right now as we speak. They're working on a bill, and I guess I can say this, it's hard to know. There's a real disclosure problem with pension information, and it's hard for people to know, okay, is my pension fund okay or is it not okay? A good clue is the health of your own employer. If your company has a below investment grade credit rating, if they can't issue bonds without them being junk bonds, that's a good sign that you need to watch your pension plan very, very carefully. And so one of the things that they were thinking about doing with this bill was say, okay, if you are a junk bond rated company, you have to handle your pension fund much, much more carefully. You have to fund it more robustly. You have to disclose more information. And there are some big, important companies that have junk credit ratings now that really would have a very hard time dealing with that if it were made law. So that's one thing that they're hung up on at the moment.
Can you name the companies that come to mind that fit that description?
Sure, a lot of them are in the auto industry.
That's the ones I was thinking of.
Yeah.
Ford and GM were just downgraded to junk status, am I right?
Recently, yes, and some big suppliers to them too, like Delphi and Visteon. And for those companies, you know, they're under a lot of pressure already from a number of different fronts, and all of a sudden to have to put hundreds of millions of dollars into your pension fund as a result of a change in the rules, they don't want to have to cope with that too. But from the perspective of wanting to keep the pension fund viable, it would help.
So I'm guessing that there's some lobbying going on.
Yeah, and in the last couple of days, that's what I've been watching. Actually, the airlines have also had problems with this bill because for most companies it would tighten up the rules very much. Companies would have to fund their plans more aggressively. For the airlines, there are so many airlines that have either been in bankruptcy recently or are in bankruptcy now or could be in bankruptcy. For them, the Congress is sort of leaning more toward helping those companies and giving them a break on their pension contributions. So it's sort of an odd thing. You would strengthen the rules for most, but for that one sector, you wouldn't strengthen them, you would relax them. And there's a lot of arguing about whether that's a good idea or not.
But I think there's sort of a fundamental question here is if this bill or something like it were to go through, you would basically be asking companies that are in the worst financial shape to cough up more money at exactly the moment when they can't.
That's right.
How realistic is that?
That's right. And so what some have proposed would be, okay, if you're in that situation, we will make you fund much more robustly, but then they talk about maybe we'll give you longer to do it or less time to do it to help. There's also talk about, okay, if you have a situation like that, why are you letting your employees build up more and more benefits? Because it's really a hollow expectation. You're telling your employees you have a secure benefit, it's going to grow every year, and at that point it maybe shouldn't anymore.
It seems very inconsistent to say on the one hand, you know, gee, we feel really sorry for you, we'd like to relax some of the terms, and then at the same time, how dare you put at risk these pensions? These are very contradictory signals that we're sending all at the same time.
It's why Congress is having such a hard time doing it. And for the employees, if you think about it from their point of view, I mean, there is a chance that the whole thing would work out, so that if Congress said, okay, General Motors, stop, you can have the pension fund that they've earned so far, but they can't earn any more benefits. The employees really don't like the sound of that because there is a chance that the whole thing still could work. Finances could change. And then you also have a guarantor backing it up in the government. And so they're thinking, well, why should we take this? It's effectively a pay cut. Why should we take that? Maybe the thing will still work, but it's putting a big risk out there, and who bears the risk is the government.
Now, traditionally, does every company pay the same amount of premium no matter what they invest their securities in?
Yeah, the premiums, in the beginning it was $1 per person, and it has gone up a little bit. Congress sets it. And again, there's a lot of lobbying that goes on, and so it hasn't risen at the same speed as the risk has risen. And so now it's $19 per person for most companies. If you have some underfunding in your pension fund, then it can be more. But even then, it's independent from what the pension fund is invested in. And so if you had very volatile assets or if you had very conservative assets, it would still be the same.
So if I'm a company and I've been doing a really good job of keeping level with my obligations to my workers, and I'm sitting right next to someone who's done just the opposite and put all the money into high risk but potentially high reward junk bonds or whatever, we're both paying the same premium?
Yes, and this is why right now the airlines are kind of arguing with each other, because some of the airlines that aren't in bankruptcy, for example, Continental, they're sort of thinking, why are we going to be penalized here? And they've been somewhat outspoken about it. That hasn't been resolved yet. It's one of the things that's hanging up this legislation.
Has anyone said, why not have the people who want to, if you want to invest more in more risky securities, you should be allowed to do that but pay more?
There used to be some talk about that, and I think some government officials floated the idea in speeches and things and got such bad pushback. People said they were un-American, basically. They said, how can it be possible that you don't want us to invest in the stock market or invest in whatever? How can you, the government, tell us, the corporations, what to do? And on the one hand, yeah, that's right, a corporation should be free to do what it wants with its money, except this is not just business money. This is special money that's supposed to be held in a trust fund for the retirees. And the government is sort of going along for the ride.
Well, the government is the backstop. The government is the ultimate source of these funds, so why wouldn't that allow the public to have a say in policy?
You would think that, to me it makes sense that that should be part of the discussion, but I can tell you it isn't, and I think there was just too much pushback. So you have sort of a heads you win, tails the government loses situation where they can take advantage of the good returns they may get on their investments, but if the whole thing goes down and fails, the government gets it.
It doesn't seem like a very good system, and as a taxpayer, I feel, I'm not in a good shape here.
I think there would be a lot more outrage, except people just don't know.
Have you had any luck with your articles trying to get some of this across? Have you had feedback?
I hear from a lot of retirees. They're glad that any journalist is interested in this. I don't think anybody really knows what the answer to it all is. We can see that there's a big problem, and we're following this problem along. Where it's going, I don't know.
What would you advise someone who is watching this show if they're concerned? What questions should they be asking themselves, and what work or due diligence can they do?
I, as a journalist, think the disclosure of pension information is awful. It's secret in some ways. There are things that have been excluded from the Freedom of Information Act, so that the government is involved in this, and normally you can find out information about government costs. Pension information to some degree is exempt from all of that. So if you're an employee and you say to yourself, gee, I would really like to dig out some of these facts about my pension fund because this is my money for my retirement, sometimes you can just run up against a wall where you can't find that out anymore, and you're never going to find a journalist who thinks that that is good. And so
where would you start, though?
Well, I can tell you also, I don't want to come across as if every pension fund is about to fail tomorrow, because that's not the case. There are lots that are in good shape. And if you're an employee, a good starting place really is looking at the health of your own company, because as long as your company has a good credit rating, presumably it has the cash to put into its pension fund also, and the whole thing isn't going to run down. Once companies get to junk bond status, things can start happening very fast, and employees of companies like that really need to be keeping an eye on their pension fund and pushing for more information.
Now, is this only in the defined benefit funds, or is this more broadly an issue?
It's the defined benefit funds are the ones with this guarantee and with all of these rules about how much companies are supposed to put into this trust fund. The trust fund, by the way, there are accounting advantages that companies get by running a trust fund, and that's one other thing to keep in mind. The rules for that accounting can sometimes give companies a financial incentive to invest with more risk.
So that's, again, something that could be changed if the lobbyists would stand back and let some level-headed policymakers step in.
I think the chairman
of the naive world that I would love to see.
It's not naive. The chairman of the board that sets accounting rules has been talking for, I think, 3 years now about how this would be a good idea, and I think they may be voting on a project this fall.
Well, that would be an encouraging sign. There was a story in your piece about a pilot at United who tripped over this many years ago. Can you just share with us, how did he figure this out, and what did he do about it?
He was a very astute person. He was plugged into the pension fund because he had some sort of fiduciary role, I think. He was, for the pilots union, he was an official with responsibility for monitoring the pension fund. What he could see, there was a time when pension funds were handled much more conservatively, and he was aware that at United that had been the case, and it was changing. They were investing in riskier, more volatile assets, hoping for better returns, of course. And then they also, in the past, when a pilot retired, they sort of cashed him out of the pension fund by going to an insurance company and buying him an annuity, so he wasn't in the pension plan anymore. And they were stopping that too. They were keeping all these people in the pension fund, I think, as a way of like having more capital in there and a better chance at bigger investment gains. And he could see there was a chance that the whole thing would melt down at one point, and he warned them, and no one paid any attention. His own union wasn't interested in backing him up on this.
It's a sad story. We've been very fortunate to have New York Times reporter Mary Williams Walsh as our guest today. Thank you, Mary, for being on the show.
Thank you.
We'll be right back.
Some people think of New York as the world's second home. The City University of New York, with students coming from 90 countries and speaking more than 155 languages, is the world's first university. Find us on the web at cuny.edu or call us at 1-800-CUNY-YES.
As Mary Walsh writes in one of her articles, the risks to United's pension fund were so obvious to one of its own pilots that he repeatedly tried to warn his union about it, a mere 18 years ago. What he noticed was something relatively simple. The company was funding what it knew would be predictable future obligations to its employees with risky investments that would almost certainly fluctuate and not be available when they were most needed. When companies like Enron and WorldCom went bankrupt, regulators pursued those in the financial industry who had contributed to employees' losses with zeal. They recovered billions of dollars that way. However, airline employees, whose pension funds are now depleted, have not seen similar recovery efforts on their behalf. That is especially surprising since the obligations of these businesses will eventually fall onto taxpayers. At the very least, companies that want to take greater risks with their employees' pensions should be required to pay higher insurance premiums for the privilege. It would be even nicer if some of the consultants who made so much money giving bad advice had to suffer some financial consequences. For USA Inc., I'm Sarah Bartlett.